Great, so you've got the heading. Last chapter, 31, forecasting and managing cash flow. First thing we need to do here is define what those terms mean. So the word forecasting means to do what? Any idea? To forecast.
To predict.
To predict, 100%. So to predict / estimate what will happen in the future. That's important. And why should we forecast cash flow? Well, remember earlier today we spoke about businesses that don't make a profit. Can they operate? Yes, as long as they manage their cash flow.
Yeah.
That's important. So inflow and outflow both have to be compared, and that's used in a cash flow statement. The managing is important. Managing cash flow requires the business to ensure that the inflows are greater than the outflows. That's very, very, very important. See, that's the management. So two things here. The one is the forecasting and the one is the managing. Because remember, you can forecast. You can say, well, okay, I have a budget. I'm only going to spend X on this expense this month.
Yeah.
But now the managing is, well, in reality, things can change. So now let's say you're going to spend X on, let's use an example, let's use transport, let's say distribution. So let's say you're transporting your goods from one place to another, and you're planning to spend X on fuel. And now we have a big increase in the petrol price. Are we still going to spend X? No, we're probably going to spend more than that. So that's the managing. So forecasting is having a plan, managing is dealing with the reality.
Yeah.
Forecasting is creating a plan. Managing is dealing with the reality. Right, so if the petrol price does go up by 1, 2, 3, 4 rand a litre, that's going to affect the business. The business might not have forecasted that, so they wouldn't have expected that. But they're now going to have to manage it. Okay, they're going to have to deal with it, and that's the difference here. Okay, so that's what you're going to be looking at in this chapter. It's quite a short chapter, it's about 7-8 pages here in total. And you're focusing on these two important topics. Forecasting, meaning predicting, and managing, meaning dealing with it. Okay, so if the price does go up, let's deal with that. Can we or can't we still buy the petrol? That's the big question mark that the business is going to have to deal with. Okay, so chapter 31. Introduction talks about a company, a glass business. They say cash flow is important because even if the business makes a profit, but they cannot pay their bills, they will go bankrupt. That's what they've said here. Let's write that down. If a profitable business does not pay its bills, they will go bankrupt. In brackets, meet your obligations. That's so important. And we know, we just covered some accounting, that an obligation is a liability. So if we can pay off all our liabilities, that's very, very good. Just a separate note here. When businesses have more assets than liabilities, brackets, sustainable. And that's the key. So the best way to check how healthy a business is just look at its assets and liabilities. How much does it have and how much does it have to pay? If the business has more than it must pay, that's a successful business. Right? It's very straightforward. It's just like human beings. If you've got more assets and liabilities, you're in a good position. If it's the other way around, well, then you're not sleeping at night because you're worried about all the creditors.
Yeah.
Okay, and the debts. Right, we know debt is bad. Okay. Perfect. Two words that the textbook gives you that we need to define. The first is liquidation, which actually has come up again for the second time. I remember mentioning this before, but it's in this chapter as well. Okay, liquidation, according to the textbook, says when a firm ceases trading and its assets are sold for cash to pay its suppliers and other creditors. I'm going to show you that because I know you like using those definitions. Liquidation, I'm going to keep it simple. Bankruptcy. A business cannot pay its obligations. That's what it means to be liquidated. Okay, so a liquidation is when we're selling off assets. Okay, that's the worst situation to be in. If a business is bankrupt and they're selling assets to pay off liabilities, you know things have gone completely off. Okay, in terms of off the rails. Okay, things haven't gone well at all. And then the second thing is insolvent. That's the next definition. Insolvent, when a business cannot meet its short-term debts. Yeah, so you have the word bankrupt and insolvent. They both mean the same thing. The one just looked at more short-term and the one looks at more long-term. Right, so if you're bankrupt, there's no way you're going to come back. Okay, the business is going to fail, the business is going to be liquidated. If you're insolvent, that means you can't meet your short-term obligations. So now I can't pay my creditors, I can't pay my suppliers, I can't pay my expenses. Right, so they both mean the same thing. So you can use both words in the same context. They've just chosen to differentiate between the two in the textbook. But we know both mean something bad. Okay, you're writing cash flow as well? Yeah, that's perfect. Cash flow is inflows and outflows. I think I wrote that previously. Yeah, well, on that previous page. So it's very, very important for a business to manage cash flow. It's probably the most important thing to manage. Business can deal with the loss. Businesses can deal with profit, obviously, because that's good, but they can't deal with not having enough cash. Not having enough cash on hand is the worst situation to be in for a business.
I'm sorry.
Okay, still busy. that right?
Yeah.
Perfect. Next point, heading here, cash and profit. Okay, or cash versus profit. We kind of touched on this when we were talking about some of the accounting, but I'm going to summarize what they've given you here. They've given you an example as well. Here they talk about Hunter. Hunter buys fresh fish from a market every day. She pays cash to the traders and gets a good deal because of this. She then sells her stock on a high street stall to shoppers who pay her cash. Is Hunter going to have a cash flow problem? No. Why? She buys using cash and she receives cash.
Yeah.
Okay, there's inflow and outflow. So long as she's selling the fish at a higher price that she bought it for, she'll always be operating. Make sense?
Yeah.
Perfect. So, example number 1, EG1. If a business buys using cash and sells using cash, inflow should be greater than outflow. Not always, but we would expect that business to sell things at a profit.
Yeah.
Right, like Hunter's fish business. Okay, example number 2, you'll see the difference now. Second example, they're talking about Shula. Shula owns a fine foods business specializing in delicacies. Last month, she bought $500 worth of fresh goods from a supplier who offers her 1 month's credit.
Yeah.
Okay, so has she spent any money? No, she hasn't. So, if a business buys on credit, brackets, no cash outflow. Has she kept money within her business? Yes, she has.
Yeah.
Then they say she sells the goods and her customers pay using cash. Good or bad scenario?
Good.
Very good. And sells for cash. Right, that's brilliant. Why? Because she didn't spend any money to get the goods that she's selling.
That's true.
But now she's selling it for cash. Now she got cash. So she kind of got cash ahead of time.
Yeah.
And then she just needs to pay it off later on. Right, that's a good place to be in. So here, inflows greater than outflows. Example 2 is very good. Let's look at the last example. Example 3. What happens now if you've got Sanjit is concerned about his competition for his jewelry shop? He buys most of his stock over the internet for cash and decides to sell or increase the credit terms to his customers. Good or bad? So he's selling on credit, but he's buying for cash.
It's good.
It's bad because he's going to have cash flow problems.
Yeah.
He's outlaying money today and not getting anything. So here's the second example. If a business buys for cash, brackets, big outflow,
Yeah.
and sells on credit, bracket, no inflow, outflow greater than inflow, this business has cash flow problems. Okay, so best scenario to be in would be scenario 2. Scenario 2 is the best, scenario 3 is the worst. Scenario 1 is just average, okay. Alright, buy things for cash, sell things for cash. Okay, so I like using the example because it kind of makes more sense.
Yeah, sure.
Do you agree? Okay. Alright, so we've looked at that, cash versus profit. Let me ask you this, which business made the most profit?
Number 2.
Number 3 actually.
Oh.
Because number 3 is selling everything on credit.
Oh, yeah.
So will he sell more than the others?
Yeah.
Yes, he would. Okay, because people buy things on credit. So in terms of sales, Sanjit is going to sell the most. Okay, but he's going to struggle the most in terms of cash flow. See, that's the problem. Right, just last note there. Example 3 will have the biggest profit due to the credit sales, but this business will have the biggest cash flow problem. Okay, just to summarize. Okay, maybe just to put a note here. Summary. Okay, now we need to look at the forecasting. New page. Oops. What did that do? Oh, that pasted this whole thing. Okay, copy, paste. Alright, so how to forecast cash flow. So forecasting cash flow. Remember we spoke about forecasting earlier. It means to predict or to estimate or to have an expectation. So creating a plan, having an expectation. So we would expect to sell X. We would expect to spend a certain amount of capital or on expenses. Right, so number 1, the first heading they give you here is forecasting outflows. Forecast outflows. How do we forecast outflows? Well, there's a few things. They look at historical expenses, e.g. rent. Okay, do you agree rent would have been paid for in the past, so it's going to be paid for in the future? Right, that's how we can forecast outflows. The second thing is demand for goods / services. Right, so if we know we're going to have to buy lots of goods to sell lots of goods, we're going to have an expectation of outflow. They spoke about leases. Okay, leases is rent, so we've got that. They talked about rent as well, separate. Okay, so lease would be a more long-term arrangement. Rent would be seen as like a month-to-month type of thing. Then they talk about electricity, gas, water, telephone. So I'm going to summarize that. Day-to-day operational expenses like water and electricity, telephone, etc., etc. There's so many that you can maybe think of there. Next thing is labor costs. Labor costs, bracket, this would be for staff. Right, so how much do I have to pay my employees? Right, there's going to be a contract in place, there's going to be an agreement in place, there's going to be something in place that's going to help me forecast that. Okay, I know this person's going to get paid X every month, depending on what they do. Right, then variable costs, this is just other. Variable, brackets, other unforeseen costs that are, inverted commas, planned for. Okay, so if you know there are going to be certain unforeseen costs, can we budget and forecast those? We can. We can say, well, based on the past, every month I've had maybe an extra 2, 3, 4 expenses that I know that I haven't had in the past, but I know that tend to come up. Then I can forecast that, and I can say, well, if I know I've had them in the past, the chances of having similar costs in the future could be quite high. Okay. Alright, that's the forecasting outflow. Why don't they show inflow? Oh, they do. Sorry, I actually covered outflow first and then inflow. It doesn't matter as long as you've got both. Number 2, forecast inflow. Outflow is bad, inflow is good. Right, point number one, how do we do this? Owner's capital injection. So, owner's equity, money from the owners. That you will know. So you will know how much you are expecting to contribute to the business. So if the business is suffering, the business needs more capital, you can forecast that. You can say, well, okay, I know in this month the business is a bit slow, we need a bit more capital in that month to keep the business going. That's the first one, capital injection. The second one, they talked about a loan. Loans. The third one, customer purchases, brackets the demand. Right, so do people want your products and services? If they do, can we predict what we're going to get in the future? We can. Okay, we can say, well, we expect to sell 10 items next month, or 20 items, or 30 items, or 100 items, or however much we're selling, based on obviously demand. Okay, and then the last point, there's only 4 points for this one. Is your collections, debt collections, or debtor collections. That's the right word actually. Sorry, debt is slightly different. Debtors collections. And again, you'll have to look at that. So how often do people pay me? Okay, so if you've sold something on credit, do they pay me this month? Do they pay me next month? Do they pay me in 2 months, 3 months, 4 months? When do they pay me? Okay, you're going to have to look at that to forecast your inflow. Right, so we've done inflow, we've done outflow. We've got structure of the cash forecast. And then we're almost there. Last 4 pages. Okay. New heading. Structure of the cash flow forecast.
Think I can do it at the bottom here?
Yes, you can. Yeah, there aren't that many points here. Let me just see. There's about 3. You do need to do not a timeline, more a column. So I'm going to show you. Okay, let me do it maybe, and then you can just have a look. So structure of the forecast. So opening month balances will adjust to get the closing month's balance. Closing balance for e.g. January is opening balance for which month?
Closing balance for January is opening balance for February.
Perfect. Right, see that's what you're looking at here, the structure. Right, and then I'm gonna draw something not as big as theirs, okay, a little bit smaller, but just to give you an understanding of how to show the cash flow. Okay, so you can see in their book, they've got inflows, then they list them. They've got outflows, then they list them. And then you've got net cash flow. Net cash flow is the difference between the two. So, net cash flow equals inflow minus outflow. Right, then I'm going to show a little diagram here at the bottom just to show the actual workings and how to do it month by month. Let's use 3 months, not to make it too long. Okay. Ooh, I'm going to need more columns in this.
So you're doing like an example?
Yeah, small little example just to show that understanding. Okay. It's actually too big. It's fine. All right. So in terms of months, okay, I'm going to need one more column. Let's do 3. Insert a column. Okay. So January, February, March. Okay. You're obviously going to have list all the inflows. Do you agree?
Yeah.
Okay, once I've listed all the inflows, that's going to give me a total, right? And then what am I going to do with the total? Subtract the outflow, because inflow minus outflow gives me cash net flow. Yes, that's it. Okay, so that's what we're going to show here. List all the inflows. Let's say for January we've got 100. List all the outflows. Okay, let's say the outflows come out to 50. Net cash flow is what? The difference. Does that make sense?
Yeah.
Okay, so the difference here would be positive or negative?
Positive.
Yes, 100 is bigger than
50.
50, so you'd have 50 there. Good. Okay, and then you'd have opening balance and closing balance. I need to add more lines. Opening balance, closing balance. Okay, these last two are very important, so I'm going to highlight these two. Yes, you.
Sorry.
Okay. Let's fill them. Okay, and then net cash flow is looking at the difference between inflows and outflows. Right, so have a look at this example and just follow the logic. Okay, so I list all my inflows, I list all my outflows, and I see what the totals are. This was 100 in Jan, this was 50 in Jan. Which was bigger?
Inflows.
Inflows. So this is actually a negative. That will be in brackets. Okay, remember accounting puts things in brackets. So what's 100 minus 50? 50. Opening balance for January, let's say we started with nothing. What would the closing balance be for January?
50.
Yes, why? I started with nothing.
Speaking of January, yeah,
yes,
okay.
and I made 50, which was inflow minus outflow. Do you agree?
50.
So 50 there. Okay, if the closing balance for January is 50, what's the opening balance for February? 50. Okay, what you end one month with must be what you start the next month with. Does that make sense?
Yeah.
Okay, so that's what you've got there. Same thing for February to March. Right, let's say in Feb we make 200. And let's say if Feb wasn't so good, we spent 220. What would the net cash flow be?
Negative 20.
Minus 20. Good. So if you have net cash flow minus 20, you started with 50. What's the closing going to be?
30.
Perfect. Right, so now if I end with 30 in Feb, I'm going to start March with 30. Does that make sense? Okay, then in March, let's say March is a good month. We make 300 and we only spend 250. So we got more than we spent. What's the net cash flow?
50.
50. Perfect. So if I started with 30 and I made 50, I'm going to end with 80. Great. And that's what you do. Okay, that's forecasting. Obviously, forecasting is going to look at the C information. Right, so you'll do something similar in this question. Just read the information. Okay. Alright, so that's what they've described on these 2 pages. Okay, the structure of the cash flows, they talk about this. See, section 1, inflows. Section 2, outflows. Section 3, net cash flow and the opening closing balances. What we've got there. Right, then they give you the table 31.1, which is there. They've given you an example, they've shown that. Okay, list them, total them. List them, total them, then work out the differences. Okay, I'm going to put a note here. Oh, come on, there we go. Another example on page, what page is this? 467. Right, so I mean, this is small, but it gives you everything you need. Okay, there's a bigger example on page 467 if you want to have a look at that. Okay, but the logic is quite simple. Inflow minus outflow gives you the nets. Once I've got the nets, I'm going to look at opening and closing balances. All right. Yeah. What type of financial planning do we have, and the limitations? Okay, that's just theory. Okay, so last bit's of theory.
So what's this now?
Type of financial planning, or types of financial planning. What uses does this type of financial planning have? Okay, so we're looking at the financial planning. Financial planning. Okay, the textbook says there are several important advantages to cash flow forecasting. So let's put a heading here, advantages, and then we'll look at limitations, which is what you said earlier, things that we can't do. Right, so the first thing is, if I have a plan, we can stick to it. So having a plan helps with operations. Second reason is to evaluate performance. Why? We can compare budget versus actual. Right, so remember, we're talking about a forecast. So if I forecast my sales, let's say I expect to sell 10, but now I only sell 5. Have we met the budgets? No, we haven't. Okay, we've sold less than what we expected to. So now that gives you an evaluation in terms of performance, right? So maybe sales need to be improved. So let's do more marketing. Next month, let's market our products more to try to sell more. Right, the textbook then goes on and they say it also provides additional finance. So business plan. Business plan to apply for capital. Very similar to what we saw earlier. That was the financial statements. This is not a set of financial statements. Remember, forecasting cash flow is not about the present, it's about the future. And it's not about the past either. Accounting looks at the past. Forecasting looks at the future. So this is looking at a possible investor. Okay, we expect to receive X. Are you willing to take the risk? Are you willing to give us capital? Okay, that's why I'm looking at the business plan there. So maybe just to put a note here, startup. Okay, so as a startup, you are going to have to forecast what you think you're going to sell. Okay, and then the next heading, which is what the textbook gives you, disadvantages. And there's quite a few here. The first one, mistakes can be made. Mistakes, bracket, inaccurate information. Right, because this is all forecasted. So you could forecast something and it could be completely out.
Yeah.
Second thing, unexpected costs not foreseen. Unexpected costs not forecasted or foreseen. Okay, so we expected to only spend money on X, Y, and Z, but now we've got X, Y, Z, and A, and B, and C. Okay, there was more than we expected, and that's a problem. The second that they talk about is wrong assumptions. Okay, what do I mean by wrong assumptions? Brackets. We expect inflation to be, let's say, 5%, but it actually is 6 or 7%. Okay, as an example, our assumptions are wrong. Okay, so those advantages, those are disadvantages, and we've got 2 more headings. Can you put 2 more headings in? We've got causes of cash flow problems, and we've got ways to improve it, and that's the end. Okay. Alright, so the first heading, causes of cash flow problems. I'm going to label these because they did put subheadings in the textbook. Number 1, lack of planning. Okay, that causes cash flow problems. That's self-explanatory. Right, if you don't plan, you're going to have cash flow problems. Right, planning, or this is budgeting. I'm going to use the word budgeting here because that's planning, budgeting. Number 2, poor credit control. Right, so that's having a credit card and going to all the shops and just buying. Okay, no control. Poor credit control. Buying way more than you need. No control. Okay, impulse purchase. Allowing customers to pay. Allowing customers too long to pay. So poor debtors management. Giving customers very long terms to pay. That can cause a problem. Right, so if I sell something to someone today and then I give them a year to pay me, are we going to have cash flow problems? Probably, because they're only going to pay us next year. That's very, very, very late. Right, number 4, expanding too rapidly. The example they gave in the textbook here is overtrading. Alright, so if a business overtrades meaning you're just so excited to sell, you're selling, and that gets the business into trouble. Why? Because you need goods to sell, and you need to source those goods. So, resources are limited, comma, possible debts. Okay, so if you're expanding too rapidly, it can become a problem. And then the other one is bad debts. Bad debts / credit losses. That one I think you know, right? A bad debt, when people don't pay you, when debtors don't pay you. Right, that's the... Oh, sorry, there's one more on the next page. Unexpected events. Almost forgot number 6. Unexpected events. Right, again, that's self-explanatory. Things that we don't expect that arise. Okay, maybe being an accident. The business having a fire, a disaster. Okay. Alright, and then the last bit here, okay, they've actually kind of grouped these. They talked about ways to improve cash flow. And then they spoke about managing your trade receivables and managing your trade payables. Right, so the final heading, which we need to break up into different categories, is, so this was causes for cash flow. Now we're looking at ways to improve it. Ways to improve cash flow. Number 1, trade receivables. Okay, with trade receivables, you need to put subheadings here because there's quite a few. Right, the first point under number 1 is not extending credit to customers or extending it for shorter periods of time. Okay, so shorter periods of time to receive payments. Number 2, factoring. Okay, factoring we've spoken about before. I'm going to recap it if you don't remember. Factoring brackets, selling the debtors book. Right, so this is, I've got debtors, I don't want to go and collect it. So let me give it to a debt collector. They'll give me the cash today and then they'll worry about collecting the money later. Number 3 in the textbook, they said, be careful to discover whether new customers are credit worthy or not. So customer credit worthiness. We're only going to extend credit to those that can afford to pay us. And the last one is offering discounts. Offering settlement discounts. Okay, so that's the trade receivables. Last page has the payables. Trade payables. Right, so now what can we do with them to improve cash flow? Negotiate longer periods to pay off your purchases. Right, so if I can negotiate with the supplier and they can give me a longer term to pay off, that means I have longer terms, I've got more cash in the business. The second one, they said increase the range of goods and services bought on credit. That's an interesting one. So consider other suppliers. Okay, diversify. Okay, so we're not only buying from one supplier, we're buying from multiple. That could also help increase cash flow. They said extend the period of time taken to pay that we spoke about. And also receiving discounts, getting discounts from suppliers. Number 3 is inventory. That's quite an easy one. Keep less stock. If I keep less stock, I'll have more cash in the business. Just in time. Less wastage. More productivity. And then cash we spoke about earlier. Businesses need to manage their cash. We've covered that. And then they said a permanent increase in working capital, looking at their requirements. So liquidity again. They said too much liquidity is wasteful. So that's what they're looking at here in terms of ways to improve cash flow. Asterisks. This is for all of them though, not only for the one. It's just a blanket consideration. When managing working capital, keeping too much cash is an opportunity cost. But what do I mean by that? Well, that's what they just said. Okay, keeping too much is wasteful. Why? Because if I'm holding too much cash, do you agree, I'm not receiving any benefit on it?
Yeah.
Okay, because if I buy assets, I can sell those assets at profits. Okay, cash is going to give you interest, but the interest isn't going to be a lot. Okay, so the ways to improve cash flow would be the ones we've described here. Manage your trade receivables, manage your trade payables, and manage your inventory. But at the same time, also consider not holding too much working capital, because that can create a problem for the business. Okay, and that's the end of chapter 31.
Yay!